Yes, hello guys. Good afternoon, good evening, maybe good morning also wherever you are. My name is CPA Makan and today I'll be taking you through financial management. Financial management, and I hope and believe that you'll be following me on either Facebook, on either YouTube, and any other forum that might be very necessary for us to learn this financial management. For now, I'd like us to discuss about financial management, topic 1. Financial management, topic 1. And you want now to begin with the introduction, that is the nature and the purpose of financial management. The nature and the purpose of financial management. To begin with, first and foremost, we want us to ask ourselves a question by dividing this particular term into two. Financial management into two. If you ask a person what is the meaning of the word financial management, some might say it means control of assets in an organization. Some might say it is about controlling and management or directing of funds of an organization. Some might say it is an effective utilization of the company resources. All those meanings, they are actually acceptable. But now, by this particular time, one now to get exactly the meaning of the word financial management. Now, when we talk about financial management here, financial management each and every person, any business person, anybody wherever that person is purely talking about finances in an organization, finances in a family, finances in an entity, financial in the government, finances in an international global part of it. Those people are purely talking about the management of funds. And therefore, when we talk about management, it is actually wide and it needs to be understood clearly because it is mainly a responsibility of a finance manager or a financial manager to ensure that the financial management skills are properly articulated in any organization. Therefore, when we talk about financial management, here we are just talking about management of funds, management of fundings, management of finances, management of finances of an organization, management of finances in an organization. Now, in any organization, the finances that are available should be properly managed, properly controlled, and properly directed to the right place. And therefore, as a financial manager, you should be in a position to ensure that you are managing all the finances of that organization. Why are you managing these finances for that organization? Number 2 then is to ensure that in order to achieve organization's objective or to achieve objective of the organization. So therefore, financial management is the management of finances of an organization in order to achieve objectives of that particular organization. Now, when you talk about objective of the organization, We are going to discuss into detail about the same just in few minutes after introduction. Therefore, in this case, we can also say that financial management is purely about management or management of assets. You can also say management of assets in an organization. And this particular of assets and organization, we are purely talking about the cash. Okay? So financial management is a very wide topic because it concentrates on financial objectives and also non-financial objectives. So this is the meaning of the word financial management. Now, who is this person that should be in a position to ensure that the assets or the finances of an organization are properly utilized and properly directed to the effective or to the point in which they were supposed to? This is a finance manager. And therefore, let's now see the roles of financial manager. Financial manager is a company's manager or an entity manager who controls the finances of that particular organization. Therefore, it is the officer or it's an employee who actually exercises the financial management. As a finance manager, you have key roles. Role number one is financial planning. As a financial manager, you are supposed to play a role called financial planning. When you talk about financial planning, this is purely about analyzing the data of an organization to ensure that which objective or which activity consumed what amount of money or which activity need what amount of money. In that case, you'll be doing what they call planning. So therefore, planning here means you are purely doing you are actually directing activities of an organization. And in this planning here, as a finance manager, you might be planning in the form of one, short term planning, plans. As a finance manager, you should be having a short-term plans. These short-term plans will only include management of working capital. And when you talk about management of working capital here, working capital means current assets minus current liabilities. And when you talk about the current assets here, when you talk about current assets, you are actually referring to receivables. Okay? You are also referring to inventory. You are also referring to cash. So if you add these, you will automatically arrive at current assets. And when you talk about a current liability, you are referring to trade payables. Therefore, as a financial manager, you should be in a position to control the flow of cash in the organization. That is to say, you should be in a position to know how much is the current assets and how much is the current liability to ensure that you have equitable point of cash so that you don't have deficit at the end of the period. When you talk about the current liabilities here, these are liabilities that are paid within a short period of time, that is 12 months. Therefore, the difference between the current assets and current liability is what we call working capital. So, as a financial manager, you are supposed to ensure that a working capital is under control. I hope that point is clear. On the same note, we have also what we call medium plans. Medium and long-term plans. Now, when you talk about medium and long-term plans, here we are just talking about plans maybe to acquire non-current assets. Another word for non-current assets is fixed assets. Fixed assets. Therefore, medium and long-term plans is a responsibility to a finance manager. It is the finance manager that should determine what kind of fixed asset is to be bought, okay, and what kind of asset to be replaced, and also what kind of asset to be disposed. So you can see that this role of planning is very important when it comes to the role of a financial manager in that particular organization. Now, the second role is what we call, the second role is financial control. Number 2, financial control. Apart from knowing what is planning, we now want to know what is control. Control here, a financial manager should be in a position to ensure or to monitor the activities, how the activities of an organization are performing in relation to the objectives. So in this case now, if a financial manager should be in a position to ensure that the activities in an organization, are automatically meeting the objective of that particular organization. And how does a financial manager be able to discover this? By ensuring that he is able to compare the actual data, that is actual and forecast data. That this financial control, that is to ensure that the assets in that particular organization are used effectively for the purpose of meeting the organization's what? Objective. So therefore, financial manager should be in a position to carry on financial control, to ensure that the activities taking place in an organization are actually meeting the objectives of that particular organization. Number 2, to ensure that the assets, that is now the assets, now in this case cash, are purely directed to the right objective or to the right place of consumption. The third responsibility of a finance manager, which is a bit wide, is what they call financial management decisions. Number 3, financial management decisions. Financial management decisions. Now, this one is wide because it is purely about particular decisions in an organization. In this case now, the financial manager should be able to make the following decisions. Decision number 1, investment decision. When you talk about investment decisions, these are decisions that relate to or it's surrounding the commitment of funds to the viable or profitable projects. For example, it is the financial manager to decide which project in an organization should be undertaken that is producing or is promising positive net present value. When I say positive net present value, I'm referring to the difference between the cash flows, the cash flows discounted, and the initial investment. Therefore, it is a financial manager to decide what kind of project to be undertaken in an organization, what kind of project to be undertaken by committing specific funds into that particular organization. Now, when you talk about investment decisions, they are of 3 types. Type number 1 is internal internal investment decisions. These are decisions that are in the control of the firm. That means it is the firm to decide within. There is no any third party to be involved when it comes to investment. For example, internal here we can talk of number one, they can decide to say which is the new project. One, internal investment decision, in one of it or example is the which is the new project to be undertaken. The new project to be undertaken can be decided by the management of that particular organization by the advice of a finance manager. Another decision is which project, which farm, which new plant and equipment to be bought. It is actually the financial manager to decide which plant and equipment to be bought. So that one is basically based on the control or powers within the organization. The third one is to decide on what we call research and development. It is still within the control of the firm to decide what kind of research to be taken and what type of development do they want and at what cost. Therefore, it is under research and development. Then the third one or the fourth one is what we call marketing and advertising. Marketing and advertising. Therefore, it is the financial manager to decide what amount of money or what kind of marketing and advertisement are they interested, and which area do we do marketing, which area do we need more advertisement, and what will be the final result after advertisement. This one is under internal investment decision. Another investment decision is what they call external. External investment decision is purely a relationship between the company's management and another company outside. This could mean you will be talking about takeover. Takeover means purchase. Takeover. So if company A or if an entity wants to buy another company, we talk about takeover. We talk about takeover. Therefore, this is also an investment decision whereby the company or the entity at the moment is trying to buy another company. Therefore, there will be two parties. One party for the entity and another party that is buying or selling, sorry. On the same note, we can also say we have what we call mergers and acquisition. Actually, this is acquisition. So we have also what we call mergers. Mergers here means combination of entities. We can have entity A and entity B. These two entities might decide to come together so that they can run as one, for them now to control the market and increase the market value. And therefore, it means that mergers is very important. It involves between the management of the company A and the management of company B. So this one here is what we call external. That one is what we call external. The third type of investment decision is what we call disinvestment. Disinvestment. Now, when you talk about disinvestment here, it is the opposite of the word investment. This one here is the cash outflow, but this one means cash inflow. And therefore, for disinvestment to take place, it means that maybe number one, you are selling some of the assets in an organization that are in excess or a surplus, or you are disposing an asset that is old, or it can also mean you are disposing the acquired project. Therefore, in this case, you can say number one is that here you are selling of what? Sell unproductive what? Unprofitable and profitable segment. So you are selling part of the business that is not profitable. It's what you call this an example of disinvestment in turn investment decisions. Number two, it can also mean that you are selling old property and equipment. And finally, maybe you are also selling a subsidiary. So this disinvestment means you are trying to dispose. You are trying to dispose excess assets in an organization or unprofitable segment of that particular organization so that you are getting some money. So that is what you call what? Disinvestment. Disinvestment. The next part of the question now is about the difference between financial management and management accounting. Financial accounting and management accounting. What is the difference between the two? What is the difference between the financial accounting and the management accounting? So it is part of the introduction on financial what? Management. Now when you talk about financial accounting, here you are referring to a financial accountant. These are two types of accountants. So there is a financial accountant and we have the management accountant. So what is the difference? One, the difference between a financial accountant or a financial accounting and management accounting, number one, you look it under the following perception. One, financial accounting deals with the performance and the position of the company. Financial accounting deals with the performance and the position of the company. Performance here, we are talking about to know whether the company has made a profit or a loss. When you talk about the position of the company, we are referring to the relationship between the assets, capital, and the equity. Therefore, these two, the financial accounting, will give us the relationship between the financial performance, and that is performance and statement of financial what? Position. And when you talk about management accounting, on this side, management accounting does not deal with the performance or a position of the organization, but it gives an information that gives aid to control of assets. This one purely will give the position of performance and the position, but this one will give the report relating to report that will help or guide or aid control of assets. Number two, this financial accounting follow a particular format. Financial accounting has standard format that is supposed to be prepared so that each and every organization should be, when you do now comparison between company A and company B, or Kenyan financial statements and the American financial statement, they must have a common relationship. Therefore, in this case, it means that there is a particular format in which financial accounting is prepared. But this one here, no format depends. This one is format depends with the management. It is the management to decide what format of that particular information is needed. But in this one, no. It is an international format that each and every accountant must follow. This financial accounting is purely about the whole organization. The whole organization. When I talk about the whole organization, it means that organization is made up of departments. For example, I'm in the health sector. We might have different departments generating revenue. For example, we might have now the consultation department. We shall have the nursing department. We can also have the ambulance services department. They are all generating what? Revenue. Now, in this case, financial accounting will automatically consider the entire organization. But this one here, management accounting, is specific. Management accounting is very specific. Very, very specific. Now, financial accounting deals with the monetary value, monetary assets, monetary information. That the information relating to financial accounting should be in money form, value. Any information that is recorded in the financial accounting books should be purely on monetary value. That is to say, it is attached with the value. But when you talk about management accounting, it goes beyond the monetary value. So it captures it, or it is both monetary and non-monetary information. So this management accounting will carry or may contain information that is monetary in nature and also information that is non-monetary in nature. So these are the differences between the financial accounting and the management accounting. Then let me continue with the same by rubbing the board. Rubbing the board. So let me continue from there. Yes, so we are moving well. So this topic will take 2 lessons. So this is our first lesson. Yes. So we now go to objectives of financial objectives of a company. Yes, each and every company has objective. Now in financial management there are 2 types of objectives. Objective number 1, there are 2 types of objectives. Objective number 1 is what you call financial objective. Financial objective. And then we have non-financial objective. So there are two main objectives in an organization. One is what you call financial objective and non-financial what? Objective. Now when you talk about financial objective now, when you talk about financial objective, there are now two types of financial objective here. There are two. One is what you call shareholders financial objective and profit maximization. Shareholders profit, shareholders wealth. This one is shareholders wealth maximization, and this one is profit maximization. So there are two types of financial management, financial objectives. These are objectives that relate with the finances of that particular organization. So there are two. One is shareholders wealth maximization and profit maximization. So let's discuss about shareholders wealth maximization. When you talk about shareholders wealth maximization, here we are referring to a scenario where the shareholders of that particular company is getting their returns interested in at a very high interest, or it is getting enough returns from that particular organization. And therefore, for these particular shareholders to engage or to be appreciated or to find out the value in that particular organization, the shares of that particular organization must be performing well. That is to say that these shareholders here must be able to get good returns in form of dividends. If the shareholders are getting good returns from their investments, then it means that you are maximizing their value. Number two, on this particular note, the shareholders also might also be getting what they call the capital gain. Now, these are the two returns. These are the two returns that are expected by the shareholders, so that we now be able to say we have actually increased or maximized the objective. The question now here is very simple. How do we value the shares of that particular organization? Valuation of a company. Because this particular company need to be, for us to know that the company is actually in a position to increase the shareholders' wealth or to maximize shareholders' wealth, we need to measure the value of the company. Now, when you talk about valuation of the company, we have now specific methods that we can use. Method number one is statement of financial position. Statement of financial position for valuation. Now, statement of financial position, or here we are talking about the balance sheet, is able to tell us the assets available in that particular organization, and it is also able to tell us the profits of that particular organization. Therefore, those two elements in the financial statement of financial position, are very important, because they will enable us to know whether the shareholders of that particular organization are actually getting the returns from their investment or not. In that case now, we have to look at the assets. As the assets, so value the assets of that particular organization. Look at the profits, the flow of the profits. If the profits increases, for example, it shows that the value of that particular company is high. If the assets of the organization is also high, it means that the value of that particular organization is high. Therefore, it means that the shareholders' wealth maximization objective is achieved. The second method of valuing the assets in an organization is what we call break-up basis. Break-up basis. When you're talking about break-up basis, this is a method in which the company is valued at a point where it is undergoing liquidation. You assume that the company is winding up, therefore you call upon the valuers to come and assess the assets of that particular organization. In that case, you are able to know what assets can be disposed and what value. So therefore, from that point of view, you'll be able to know, yes, it is true, this particular asset here or this particular company is performing better or not in terms of what? Wealth. The third one is what we call market value. Market value here, we are talking about the price per share. Price per share. If the price per share is increasing yearly, it means that the organization value is high. For example, we might have the price for the shares at the beginning of the year being 50 shillings, and the price at the end of the year, that is here, at the end of that year, being 70 shillings. So you can see that the value, the selling price or the transaction price for that particular asset is moving from 50 shillings to 70 shillings. So therefore, we can now get the value of these shares by saying now, it will be P1, which is the price at the end of the year, minus the price at the beginning of the year. You will get now what we call P difference. That is now the difference, which is, in this case, it will be 70 minus 50 will give you what? 20. This 20 is exactly the value of that capital gain, sorry. This one is what we call the capital gain. So the share value has moved from 50 shillings to 70 shillings. If you want now to convert this capital into percentage, so you can now say that capital gain is taken by gain divided by the original price, which is P0, you multiply by 100%. For instance, you can have periods here, okay? 1, for example, 2, 3, and 4. This case now, we can have a share price as market price or a price here. Here is 5, here is 10, here is 3, here is negative, here is 10. Now, for us now to find out the gain, in this case, gain is now given by this at this now, it means there is nothing here, so it will be 5 divided by 5 times 100. You get 100%. This one will be 10 minus 5, which is 5 now divided by the original, which is 5. 10. You multiply by 100. This one will be this minus this, you get negative 7 over original. No, this over 5, sorry, over 10. You get the value, you multiply by 100. The same applies to that. That is how to get the capital gain. That is how to get the capital gain. Now, if you want now to know the total returns, remember I've said there are two types of returns. That is dividends plus capital. Dividends, that is, let me write it correctly. Dividends plus capital gains. So dividends plus capital gains, you get now the total returns. Therefore, these total returns are very important when it comes to the shareholders of that particular organization. Now, what are the advantages of this? So you can now say advantages of shareholders' wealth maximization. Advantages of shareholders wealth maximization. Okay, shareholders wealth maximization. Are there advantages? Yes. Advantage number one is that it gives reports for a long period of time. It covers a long period of time, meaning that if you want to get a report here, you can get a report from 2 years, 3 years, 4 years, 5 years. Okay. Number two, it accounts for uncertainties. Uncertainties here are talking about risks. Another advantage here is that it considers time value of money. Time value of money is a topic on its own, whereby we shall be discussing about the current value, current money, and future money. And whereby we shall be concluding by saying that current money is more valuable than the future money. So we shall be discussing this one in the future. That this part that's in a few days from now. So this particular time of value is very important. Then number three, we can also say number four, that in this case here, it considers there is no manipulation. No manipulation. We say that there are two types of what? Two types of financial objectives. One, shareholders wealth maximization. Two, profit maximization. Profit maximization. Now, profit maximization here, this is where the objective of an organization is purely to increase the profits. And for us to increase the profits, we can now say take the total revenue minus total what? Cost. And there are two ways in which these profits can be maximized. Method number one is to hold total revenue constant, okay, and decrease what? Costs. So if you hold revenue constant and decrease cost, you'll be maximizing your profits. Another way of doing the same is to increase revenue and hold expenses or costs constant. And this profit maximization is the main objective of any organization. Any entity that comes up, this is the main one. This is what is in the mind of the owner. This is in the mind of that particular owner. That is what is in mind. But even though it is the main objective in all, it has disadvantages. It is not that attractive. Disadvantages of profit maximization. It is not that attractive because of these disadvantages. Number one is subject to manipulation. Meaning that in this case, there is what we call creative accounting, whereby some of the figures might be manipulated to ensure that the profits are maximized. So it is a very vulnerable method of measuring objectives. Number two, it is for short term. It is for short term, meaning e.g. 1 year only. So it cannot be used to project 2 or 3 or 4, 5 years like this one here. Number three, doesn't consider doesn't consider time value of money. Yeah, it doesn't consider the time value of money, that the current money is more valuable than the future money. So that is the point there. Another one here is that it doesn't consider the volume of investment is ignored. Very important. That even though we are increasing profits, this particular objective does not consider the amount of money invested in that particular project, and therefore it ignores all that. So these are the disadvantages of profit maximization. That is it. Then we go to apart from this, apart from shareholders wealth maximization, we can also discuss another one which is actually part of the profits, but here we are going to talk about earnings per share. So another method of measuring is what we call earnings per share method. Now earnings per share, it is part of the financial objectives, but now in this case we are only concentrating on the earnings per share. And when you talk about earnings per share in this case, you are you need to take the total earnings of that particular organization, and in this case it is total profits of that, or after profits of that particular organization, or it can be loss. So therefore, for us to get earnings per share, you need to take the profit for that particular organization, net profit. You need to take the net profit, or it can be net what? Loss. You divide by the number of shares. So when you take now the net profit of that particular organization, or net loss of that particular organization, divide by the number of ordinary shares, you automatically get what you call earnings per share. Okay? And it's another method to measure the value of the organization. If the earnings per share increases, it means that the shareholders' wealth is maximized. The wealth is maximized. If the earnings per share is decreasing, if for that matter, it means that the wealth is what? Minimized. So therefore, it means that shareholders are not earning as expected. For example, I have a question based on the notes that I shared. There's a question here which says, Walter Wall Carpets made profits before tax in 2000 X, yes, of 9,320,000 shillings. Tax amounted to 2,800,000. The company's share capital is as follows. So this is the matter. This is the question that I've just been given. Let me look for the duster. Yes. This question reads, let me just read the question because I'm not getting the duster. Let me read the question first. Walter Wall Carpets made profits before tax in 20X8 of 9,320,000. Tax amounted to 2,800,000. The company's share capital is as follows. Share capital is as follows. Ordinary shares, 10 million shares, each 1 shilling. 8% preference shares, 2 million. Total, 12,000. Required, calculate the EPS for 20X8. Calculate the EPS for 20x8. So we can have solution. In this case now, we have been told calculate the earnings per share. The question says, Walter Wall Carpets made profits before tax 2 million. So you now say profit before tax is 9,320,000. This is the profit before tax. Then tax amounted to 2,800,000. Then you now less that tax of 2,800,000. Immediately subtract that one, you will get now profit after tax. Profit after tax. So what is the figure here? 0, 2, 13, that is 5, right? This is 7, this is 8. 8 minus that is 5. I think so, 5,000, eh? This is 8 minus 6, sorry, 6, then 0, 0. Then, besides this, we have also been given an information that there is 8% preference shares. That amount, that 8% preference shares, is refers to preference dividends given to the preference shareholders. So therefore, it is subtracted from here. So you now say less preference dividends. It is 8% of 2 million. 8% of 2 million will give you what? 160,000. So immediately you subtract that, you will now get what they call net profit attributable to shareholders. So let's subtract this 60. 0, 6, 4 minus that is 3, 6. So this is 6,360,000 net profit. This one. Then on the same note, you are told the ordinary shares were 10 million. So therefore, you now say earnings per share will be 6,360,000 divided by the number of shares, 10,000. 10 million, sorry. That and that. This one will be there. This one will be there. So this gives you 0.63 shillings. So the earnings per share is 0.63 shillings. Or we can say equals to 63 cents. Or we can say equals to 63 cents. Equals to 63 cents. Now we go to non-profit, non-financial objectives. Then we end there for today. Non-financial objectives. So, non-financial objectives. Non-financial objectives here, we are referring to those objectives in organization that compete with the financial objectives. That if you want to achieve non-financial objective, it means that you have to compromise with the financial objective of the organization. Because these non-financial objectives will consume some of the revenue that you have set aside for improving that particular profit. And therefore, non-financial objective is purely competing with the financial objective. Therefore, this one competes with the financial objective. Now, number one is what they call welfare of employees. The welfare of employees. Now, welfare of employees is not an objective of an organization. It's not a financial organization. It's not a financial objective, sorry. But it's a non-financial. Does not relate with the money. But what happens here is that for these employees to have that goodwill, you need now maybe, for example, pay them good salaries and wages, give them conducive environment to work, give them a good retirement package, and these employees will be able to enjoy that particular area. So you had not budgeted for the employment, for the retirement, but you need to incur that particular cost. Another one is what they call the welfare of management. Management here, we're talking about the top management now, not employees in this case. These are people, these are managers in the organization that they pay themselves huge retirements. And because it is not a financial nature, it is a non-financial issue, but need to be captured very well by the organization. And therefore, these managers need to be paid well. Number 3 is what we call provision of services. There are some of the services that this particular entity is committing itself to the community. We call it corporate security, corporate social responsibility, CSR, corporate social responsibility. So when you are carrying on corporate social responsibility, you will be incurring some costs, and therefore you'll be compromising the financial objective. Another one is what they call welfare to the customers. You see, your customer need to, when the customer visits your office, you have to ensure that your office is very attractive. Ensure that you have carpets down here, you have curtains well there, you have chairs which are of modern style. When you have them now, you see you are making your customer what? Comfortable, but you are incurring a cost. So it is competing with that particular objective of financial. Another one is what you call suppliers. Yeah. These are the people who have distributed goods to you on credit, and therefore they are expecting you to pay something. Now you have also to take care of their welfare. And the last one, number 5, number 6 is what we call welfare of society. Welfare of society. Society is just the general public. General public. Now, any organization has a corporate social responsibility to that environment. In this case, the organization should be in a position to control the pollution. The organization should be in a position to ensure that there is employment to that, there is pollution. Also, there is what they call development in that particular area. So they are incurring some costs. Therefore, these are examples of non-financial objectives. In summary, we have said that financial management is the management of finances of an organization in order to achieve objectives. Number 2, we have also said that as a financial manager, you have 3 main roles. Role number 1 is financial planning. Role number 2 is financial controlling. Role number 3 is financial management decisions. And we have said that financial management decisions are divided into 3: investment decisions, financing decisions, and dividend decisions. And the 4th one, risk management decisions. There are 4. We have also went ahead and said these objectives are divided into 2: financial objectives and non-financial objectives. Financial objectives are made up of 2: profit maximization objective and the shareholders wealth maximization profit. And we have discussed about the financial objective. That is to say, financial objective, we have discussed profit maximization and shareholders wealth maximization. So profit is the main objective for all the organization, but it has disadvantages. 1, the profits are subject to manipulation. The profits are for short period of time. Profits does not consider time value for money. Profits here are actually, the profits here does not consider the amount of investment in the organization. We also said that the one that is most preferable is what we call the shareholders' wealth maximization. Why? Because of the disadvantages faced by the profit maximization objective. Now this comes to solve the problem. Now, shareholders' wealth maximization will solve this problem. Number one, it considers time value for money. 2, it considers uncertainties or risks. 3, it is hard to manipulate the figures. And number 4, it considers what? Investment, a volume of investment. Now, we have also gone ahead and say non-financial objectives are made up of 5 elements. 1 is the welfare of the employees, welfare of the management, welfare of the customers, welfare of the society, welfare of the suppliers. So all will form part of non-financial what? Management. Now, I hope and believe that you have enjoyed the topic for today. Next lesson will be purely about stakeholders. Stakeholders. What is the difference between the shareholders and the stakeholders? That is the next topic that we shall be handling next lesson. Thank you so much, and like this particular video, share, invite your colleagues, your friends, because I'm moving at a very high speed to ensure that your syllabus are covered on time and to ensure that I do revisions well so that you pass your coming exams for both CPA students and ACCA F9 paper. So, thank you so much and have a blessed time.